After 18 straight Mondays to the upside for the NASDAQ and 17 out of 18 for the S&P 500, we had another Monday to the downside, the first for the NASDAQ to the downside. Now granted, they were both small down days, but finally did break what was the longest streak for the NASDAQ of Mondays to the upside. And it kind of gives you an idea of why, I mean, even during the bearish, during this correction we've had over the past so many months, you still rallied on Mondays. The markets were looking for some positivity coming out of weekends, and maybe in some weeks held that and rallied to the end of the week. And other weeks, that was the extent of the positivity for the week, and we fell throughout the rest. So we'll see how that pattern continues, whether or not we are forming the high or the low of the week here today. We got a lot of big things on the calendar out the rest of this week, so a little bit of a calm before the storm, so potentially. We've already had the storm. We've already had quite a move. Might be more like an eye of the storm, considering we've already had quite a bit of volatility. The question to the upside, right? Good volatility, movement to the upside. Now the question is whether we can actually kind of duplicate that going forward from here. So we get a little bit of an eye of the storm, and can we do it again going forward? So I'm going to break down, the probabilities and the likelihood based off of what the charts are looking at for us to continue to rip higher, especially considering what is widely expected to be a really soft inflation number coming out here. And of course, all the retail data and earnings associated with that sector due out, and all the Fed speak throughout this week. Will yields continue their decline? Will equities continue to just rip to the upside to the large extent that it already has? So we're going to break all that down in tonight's video. We'll take a look at what sectors are doing well and which ones perform today. That kind of gives an indication of how risk on we were today. And then we'll take a look at our trade idea of a stock that is breaking out with a nice pattern to the upside too. Not as aggressive, but a decent pattern for the stock. And we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, November the 13th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. You can see that. Come down here to the bottom, click this heart. It opens up this tab. Hit that like button there. Also click this thumbs up icon. It opens up this tab. Hit that like button there as well. Again, the more you do that, it helps get our content out to all of our followers on these platforms. That's why we always ask. It's a big deal for us. I noticed Brandon's been getting to 100 likes on his, so that's the goal for all of our videos. So let's see if we can't get out of the 70s here and see if we can get closer to those triple digits. You can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator. You can see we didn't break a streak. It actually did break the streak on the NASDAQ. We had, 18 sessions in a row, Mondays in a row we were to the upside. This is the second Monday that we've been down. This was another Monday right here that we were down. Looks like about 7 points. We were down 7 points there. And then today we were down about 4 points. So very small losses on the 2 Mondays that we were down. Very, very small losses. Now, of course, the question is this the low of the week or is it the high of the week? And we've seen it be the low of the week the last couple of weeks. Now we'll see if that, and we did retest the low on Thursday last week, but it pretty much set the low of the week on Monday. Now the question is whether this will be the low of the week or not. We'll see. So the near-term line, of course, is at extreme highs, back above the 90th percentile. The intermediate line is in the upper reversal zone. Remember, it doesn't matter. The crossover between the blue and the green lines don't matter if it's in the upper or lower reversal zones. And if the intermediate line's up here, then to change that, you need to get the near-term line down into strong lows, kind of like this down here. So that's not the case right now, obviously. Near-term line's joining it up there. The momentum line kind of leads the near-term line down. So if you're going to get the near-term line to drop down to these extreme lows, you need the momentum line to have another low like this, like we had on Thursday. That was a pretty significant jump from Thursday to Friday. In fact, we were flirting all day today with a cluster. It was kind of off and on throughout the day, as small as today's range was. A cluster there, this would have been 11 days since this oversold cluster. That's the fastest time that I've seen, and going back 20 years, because I just kind of started eyeballing it by going back. So the previous record that I had seen was in 2014, 2015, where we had 13 days between an oversold cluster and an overbought cluster. Technically, we could still get an overbought cluster tomorrow, and we'd still set the record at 12 days. I doubt it. It's kind of hard the momentum line to stay up here. Usually it doesn't stay up for very long before falling. So we'll see if that ends up being the case here. We're less than 3%, but we're above that 2.5% mark. That's the important mark, is 2.5%. So at least we are, up. We have dark green shading, a green line. That's the case for the Dow Jones Industrial Average as well. We didn't get the cluster. Came really close to getting a cluster on the Dow Jones. The momentum line was at 79.15. So again, very short amount of time. And then again, you can see, in fact, when you look at, of course, the rate of change for 11 days, I mean, this is still one of your bigger 11-day moves that we've seen, coming off of that low point in quite some time at 7% now. You have to go all the way back to over here. Here, let me zoom out a little bit. You have to go all the way back to right here was the last time we had an 11-day rally of 7% or more. And of course, you can see the negative 11-day run that we had coming off of that. And of course, during corrections, you have these big moves over 11 days. And of course, they always lead to some pretty big moves over 11 days to the downside. So we're going to get an 11-day run to the downside. The question is how big it will be, of course, and when it will start. I don't know if today will be day one of those 11. We'll have to see. But as you can see, as this oscillates up to down, that means after you get strong 11-day rallies, especially the strongest 11-day rallies, you tend to get pretty big 11-day declines. And you tend to only get these strong rallies when you're in corrections, right? Or if you're coming off of a correction low point. You can argue here in October you're coming off of a correction low, even though, eventually you ended up just producing an intermediate pullback here, and the correction had already ended. So we'll see how that plays out. Of course, your Dow Jones Industrial Average also up pretty strongly. Your NASDAQ 100 was up nearly 10%, so now we are at a 12-day. NASDAQ had one more positive day there that the S&P did not. So we're up nearly 10% there. Again, very strong move for the NASDAQ 100 that typically, as you can see, if you follow my cursor, there's one in 2023 in the early part. In 2022, we had two. And then, of course, back here in 2021, we came close. All four of those moves that were this strong over such a short amount of time were peaks, ended up producing peaks and pretty decent declines coming off of all of these. Down to at least 5. We got to a 6% 12-day decline over here on the NASDAQ 100, even on just a little bit of a pullback. So that's kind of what the market forecast is telling us. It's a nice, good move. We almost got a cluster on the Dow. The NASDAQ wasn't as close to a cluster, a little bit more down 0.3%. The near-term line, though, at bullish levels. Of course, your Russell is the one that's been the worst. The Russell here, the near-term move is not very strong at all. It's barely above the intermediate line. So the question now is whether we'll actually cross through that or not. We're below the moving average. This is the only index that has dark pink shading and a red line. So it kind of goes to show that not everything is bullish, and it tends to be more so in that mega cap name or anything influenced by those mega cap names are what's driving the price action here. Of course, you're getting another strong bullish candle. It's a higher close as of right now. The candle is smaller, and it will get smaller. That's how this works. You'll start to get smaller candles. Doesn't mean we have to be bearish. The Russell 2000, on the other hand, though, did not get that bullish of a candle. We got a red arrow again, and then now we're back to a bearish candle. So it kind of goes to show again the discrepancy, and the PPO is continuing to fall on the Russell 2000 here, as it's in a death cross environment now that so far the S&P actually avoided. The S&P avoided this death cross by coming right back up, and we'll see how much longer it can avoid that. Of course, you have 3 green arrows on the S&P, the NASDAQ, and the Dow. All 3 of these look the same. Obviously, you only had 3 green arrows for 3 days on the Russell, and now you're back to 2 red arrows, not quite having that 3rd one yet. When you look at the 2-line version of this, you can see again above the 50-day moving average, right at that 23% retracement of this rally, the previous intermediate rally, that we're trying to restart a new intermediate rally here. So we're almost back above that 23% retracement level on SPY. Of course, on IWM, we fell below the 100% retracement line. We're nowhere near. We're still below that 100% retracement line. And we're still easily below the 50-day moving average, below the point of control, below the value area, below the 8 and 17-day moving averages. MACD is negative, barely. Stochastic's below its moving average. You can see how light the volume is down there. So, again, we were kind of looking for some good bullish kind of breakout patterns here. We did get the cluster on SPY. We came short on SPX. We did get it on SPY. But, again, we dipped our toe below 20. But we're not above 30, so your ADX is actually falling here. You got the strong rally. In fact, when you look at the DMI, when you cut this in half, you cut that DMI in half, so you can kind of see the short-term movement, directional movement. The ADX is actually still above 40. We're still strongly bullish, though even the positive indicator there is already falling down. So it kind of goes to show that how as strongly bullish as we are, we should be a lot more bullish in some of these oscillators. The RSI and the CCI, trying to get above 60, can't quite get significantly above 60. Can't get there without the CCI above 152 as well. Also, it is the CCI weekly is above 0. It's not back above 100 yet. That's what starts the new long-term moves to the upside. So we don't have that. It's still below that positive. It's above 0 at least. But again, this is kind of that sucker zone that we saw like in March, where we got up to positive 50, 47 before rolling over. So it's, we'll see if we end up getting a similar move. In fact, I think I talked about that in the market outlook on Saturday. It's a very, very similar move to what we saw here at the end of March going into April. Very similar candles. So if you didn't check out Friday's market outlook, check that out, and you can be able to see that there. You can see the RSI and the weekly charts easily below 60. Here we go. So if I were to come down and take a look at like the Ichimoku cloud, again, we are at the top of the cloud. We have a positive rate of change. We actually now have a weak bullish trend going because the parameters already get above 1, which we are by 0.008 of a point. And get above 50, which we are by 0.2 of a point. So, that is about as weak of a weak bullish trend as you could possibly have. And again, as strongly bullish as we've been over 2 weeks, it is so far. That kind of goes to show how bearish we were. That this rally, which is record-setting in so many ways, at least in the last so many years, has produced the weakest of bullish trends. Again, it kind of goes to show the context is so important when you're looking at these moves. When you take a look here at the Bollinger Bands and the Keltner channels, as strong as that momentum has been, again, we're not above the Keltner channel. We still haven't gotten above the Keltner channel. We still haven't even gotten in the upper quartile. We've kind of flirted with the upper quartile, just like we did over here in August, but we haven't broken through that upper quartile to really be on a trend. And so even the Bollinger Bands are telling us we're not. The band width itself is pretty darn high as it got when we were on this bearish move to the downside. But as strong as this move has been, and that's produced a DMI, where it's gotten to on the short term, and produced this bandwidth as high as it is, produced this strong momentum, relatively strong momentum, we still can't break out. We still can't even just produce a trend here, according to some of these trend strength indicators that we look at. Of course, looking at the 4-week range, you can see we got a new 4-week high point, so that's 3. So we're not going to get a 1 touch this go around. That's good. Of course, you don't have the new 4-week high in IWM, nowhere close. So you're still kind of, in this bearish mode here, and more likely to set a new low than a new high point anytime soon. So, but we did get a, when we look at the range today, like up against last week's high, up against Friday's high, which was last week's high. Very, very small range, about as small as you could possibly get here. I mean, it was, here, let's look at the actual range first. You have what, less than 3 points of a range, under 5 was the average. Look at the volume. I mean, it's a big week. There's a lot of retail data, a lot of retail earnings, a lot of inflation data, a lot of Fed speak. So there's a lot on the docket for this week that can impact risk appetite, especially from the consumer standpoint. Starting off the week with the downgrade, of course, of the U.S. credit and by U.S. Treasury credit. The outlook downgrade, right? It was not a downgrade. It was an outlook downgrade from Moody's for their rating that they have to a negative outlook. So yeah, so you can kind of see we've got a lot that, and this is a little bit of a calm before the storm. Of course, the volatility index is telling you there's been a big calm before the storm, not just today, right? The VIX was up today. Only because it's Monday, and VIX is always up on Monday. Even though the markets are always up on Mondays too, the VIX is always up on Mondays. There's a lot more uncertainty on Monday than there is on Friday. So the VIX will always generally be higher on Mondays than it is on Fridays. Your VVIX is still at 80, 85. You've dipped below the 50%. This usually coincides when you dip below 50%. It usually coincides or precedes a significant move. Generally to the upside, especially when this is the case for the negative correlation, right? When the VVIX rises, but the VIX doesn't, and that brings the 2-week correlation down below 50%. Usually you're looking for some kind of move higher in volatility, and you can see that happened over here when we dip below 0%. You can see that happen over here too, and then eventually over here as well. You got these big moves in the VVIX coming off of all of these little peaks. Drops, below at least 50%, much less 0% if we were to get that, that far down by the time this correlation is done. So in other words, we're setting up again for a move where the VVIX makes its way up, up here above 100 at least, if not a little bit higher, and the VIX itself makes its way higher. The VIX has been so oversold, well below its 15-200-day moving averages. And in fact, the this 8 and 17 day, which had crossed above the 30, the 8s now come down to the 17, so your MACD is slightly below 0 there. So it's really, are we gonna bottom out here and bounce back up, which is what I expect, or are we gonna stay below 15 for an extended period of time and bring these averages back down? And this is a really low level. Usually you don't get a move this low of where the 8 and 17 cross above, and then this would be one instance of that in 2019. But you remember, coming off, the reason why after going up above that we dropped back down below is the Fed cut rates right here. The Fed started a mid-cycle adjustment where they cut rates 3 meetings in a row, and they started to ease on their QE. They started to increase their balance sheet again. And obviously, neither one of those two things are happening this go around. So my expectation is, unlike over here where we bounce only temporarily and we came down, I expect we'll bounce up again, similar, but then stay up, right? Eventually get potentially above that 200-week moving average, and that is where the new regime really starts, right? You get the 8 and 17 above the 30-week, and now we're getting a new regime in volatility, but get above the 200-week. And we have a new regime in volatility there as well, a higher level, and that's up there at 23. So last time we kind of broke up to the upside with COVID, we were the 200-week moving average at 14. Over here we jumped above it when this correction started, and really with Thanksgiving, and it was at 20. The 200-week was at 20. So now we're at 23, a little bit higher. And we'll see if that ends up happening within the next week or two, and I actually expect that it will. All right, let's take a look at the price action here today, and you can see over the past 3 months, the pretty significant reversal here on the Qs. At one point being down 6% during this 3-month period to finishing the period up 3%. But in the same period that the Qs are up 3%, IWM is down more than 11%. So you see the vast difference here. Again, the VNQ has actually been very highly correlated. If you look at the correlation here, let's go here to the correlation chart and then look at VNQ relative to the correlation with the Qs. So let's bring up the Qs here, and we'll go 63 days in the correlation. And then we'll come over here to the QQQ as well. And this one, of course, didn't take because it's so weird sometimes. All right, there we go. So you can see it's normally a very positive correlation over a 3-month period. Very strong. There's been a period over here where the Qs kept going up and VNQ didn't really go up, and that's why it was so negative. But then they both turned higher and they both came lower. But you can see now, like again, over the past 3 months, they've really kind of gone, really over the past little bit here, they've gone in the opposite direction. If I were to change that back to a 10-day, you can see the short-term correlation between the two. Again, you see the longer-term negative, and now we're moving down to a less positive correlation as we've really kind of continued to rally up here and not on the real estate. You see the vast difference there. Commodities have been relatively bullish. Yields have been up, and again, that's typically so bonds have been down, so bond yields are higher. Again, that's generally pretty bearish for equities, and it has been, you can see, for IWM, and it has been for real estate because that higher yields will weigh on that too, but it has been weighing down on the Qs lately until now. In fact, the Qs are up here with gold and the dollar, two very historically like safe haven areas. So you can kind of see how the Qs are kind of acting like a safe haven trade in place of bonds, which is generally that third safety trade along with the currency and gold up there. So that's kind of the main thing. I did want to bring up this idea of just how far up the S&P has performed over the past 11 days here, which is the last 2 weeks and then today. So if you notice here, and you can see we're up 7% over the last 11 days. And so there's a lot of chatter about the CPI coming out this week and potential explosion that stocks can really rip higher. In fact, that's, again, Tom Lee saying that we could really get a face ripper to the upside this week in response to the CPI data and PPI data for that matter. So if you take the same, if you were to say, okay, by the end of the week will be 15 days, it'll be 3 full weeks of, since we bottomed out there before Halloween. So full 3 weeks. So this is the current return of the first 11 days, right? 7.14%, right? So that's the current return off of that. So if we were to stay flat from here, if we were going to finish Friday at 44.11, then we would have a 15-day return of 7.14. And you can see that already is a really high level. If I were to go back, even if I were to go back, it's a long time. There's been only a handful of times where we've had more, and notably during the correction here. And then, of course, during COVID, coming off those COVID lows and coming off the 2019 low, you can kind of see a big move higher there. But if you notice a lot of these differences, again, coming off the 2015 low, coming off of this low, if you try to see, okay, what's the difference between now and some of these other instances? And again, this is if we finish flat. Of course, if we were to finish, say, another 5% higher by the end of this week, or whatever move higher we end up with here by the end of this week, if we get another 5% move to the upside by the end of this week, or even just a 3% move to the upside, then you're looking at a really strong 15-day return. And that's, again, coming off of a level, it's one thing. All these other instances, the VIX was coming off of a very significantly high level. So here is where we were October 27th. We were at 21. So, you can see the big drop we've had over the 3 weeks. But we weren't even above 100%. We were at Well, by the end of the day, we were at, let's see here, we were right there. So we closed at 21 and a quarter, and we closed right there, right around, just barely above 95%. Now, the VVIX was relatively high. Relatively high. Take that back. So here we were on 1027. So we were just barely over 100. I mean, for context, coming off of the 2019 low point, right here, 2018 low point, excuse me, we were coming off of VIX right around 30. We're coming off of VIX that's barely above 20. We were coming off of VIX that was, 115% above VXV. We're coming off of VIX that's barely above 95% above VXV. So dramatically different situation. And of course, the COVID move was coming off of much even higher levels than that. So to get a 15, an 11% return off of a VIX that's barely above 20 would be like 3 standard deviation moves to the upside, which of course, this by definition means it's highly unlikely. Not 0% unlikely, but still like pretty close to 0% unlikely. So that's kind of what we're facing going into, like, are we going to get that kind of move? And again, as I mentioned last week, the big driver last week of the move was technology. XLK, that was the biggest mover. It's right now one of the only, like this and XLC, the only ones that are up over 3 months. It's dramatically higher. Even discretionary is not there. And of course, looking at just today alone, November, we'll go here to the 13th. Just today alone, again, technology giving back some of that outperformance, along with real estate and utilities down there. And you can see staples, discretionary, along with healthcare and energy. These are not sectors that typically outperform, except for discretionary. But these others aren't sectors that outperform during risk appetite. If I were to go all the way back to this, to the time this whole thing started here, post Halloween, your technology, discretionary, communication services are all the big winners, especially technology, and then everything else is lagging. Energy is actually down, and we've already seen today this reverse a little bit. So again, for us to get that kind of return where this goes up even more, by the time we're done here by the end of the week, so we're up here in this 8, 9, 10% range, then that means that it's unlikely that these are going to be the ones, and we're going to continue to get this kind of odd move as you saw here. Let's go to November. So this odd move where technology pretty much is the only gainer, and everything else is barely higher or lagging behind or even down. And this is the move since last Monday. See how everything is mostly down here. 3% for energy and real estate and utilities, while everything else, while one sector is clearly outpacing everybody else. Of course, that has an impact on the breadth. So let's take a quick look at the breadth that we've seen here lately. The McClellan oscillator bouncing back up to 30. So we've had a couple of days now back in the low 30s. And above 35 is kind of the level, and we're back above minus 500. Now keep in mind, over here in March, we also got above minus 500, and even in May we got above minus 500. So you see, we're not quite, we don't quite have the explosion of breadth that we kind of need to see to really kind of change this around. You see that here in the new highs and new lows, they're still negative, still pretty strongly negative too. Now they're above their moving average at minus 500, so we are above the moving average. That's positive. And you can see the number of stocks above the 50-day moving average is still below 250. Still can't quite get up above that range. Let's go out a little bit more for some context here. So here's that May level. We also couldn't get above 250. And there's March. March we got way higher. The moving average got almost to 300. Here the moving average is still struggling to get above 150. Again, kind of similar to this May time frame. So not quite the breadth yet that's this explosive breadth to the upside. You're kind of seeing it too here in the number of stocks above the 200-day moving average. Again, there's August, but here is May. So similar type of move that we're getting right now. And of course, March was even more. Again, the average got up here. The average right now is right around 180. Again, not necessarily so low that this is kind of a correction. In fact, if you go back out to all the corrections that we've had over the past little bit, the moving average here has gotten a lot lower than 180. Here's 180. Every single correction, including 2011, every single correction, the number of stocks below the 200-day moving average, as you can see with my cursor, that blue line, the average got way lower, right? Way lower than we're at right now. For most, down to at least 120, if not below 100. And again, we're at 180. So it kind of goes to show, the type of correction that we're having. The last kind of weak correction we got that was kind of really deep pullback, but was kind of bordering on pullback versus correction because it did take months to get back up to new highs, was the first quarter of 2018. And you can see we only got down to like 280 there. So this is deep enough, Brett, to be a correction, but not deep enough to really mark the ending of one, that we're so oversold that we have to kind of bounce off of this. Of course, the big ratio we keep our eyes on are the Qs relative to IWM, as the correlation is rising back up to its normal positive levels. We did hit a record high for this, especially when you look at, and I tweeted this out over the weekend, the ratio of the NASDAQ 100 index to the Russell index. It reached its highest level ever on Friday, well above the 200-day moving average. You can see the long-term PPO there. In fact, if you look at kind of where the current price is relative to that 200-day moving average, it's not at its highest level, but pretty close. So, 15% above about where we got to over there, and we just kind of went sideways for a while after a similar peak going into the end of May that we kind of got right now. A big, strong move, big move in momentum here, a big move in the CCI and the DMIs down here, and of course the RSI got above 70 there. But here it's a little bit different because we have already been so bullish, and the correlation was strongly positive there, and it hasn't been. So we're kind of fighting the trend right now, but it appears we're not fighting it anymore. And again, as the correlation gets back to positive, which means both this ratio and the S&P go in the same direction, what's going to be that direction? Again, considering that we're hitting extreme all-time highs, how much longer they both go up. If they both go up, remains to be seen, and more likely we start to, kind of fill in this gap down here to the downside towards the 200-day moving average with the, all these high oscillators starting themselves to roll over. All right, that brings us to our trade idea of the day. Not for solar, that's a long put we have in our options class. We have a market scholar. So if you take a look at Take 2 Interactive, you can see it just has turned bullish here. Intermediate lines in bullish territory, rising higher. We're almost 7% above the 30-day moving average. You have dark green shading and a green line. I mean, that looks really good. You look at the crossover chart here, and you can see the weekly chart. We got a good bullish candle, very strong, over 6% on the size of the candle. So really good sized candle to get us going with the green arrow there. If you take a look at the three green arrows, we obviously, with the dark green shade and the green line, we also have three green arrows, and we're moving higher with the green line there on the moving average. So that's a positive we have working for us. We're well above the moving averages. The 8 and 17 day now are both crossing the 30. That's a good sign. We're above the 30, the point of control at the top of the value area. We are pretty, but it doesn't have the greatest safety, margin of safety if we were to approach those lows again. But as of right now, again, it's looking pretty good. Looking at the DMI, you can see you have a bullish pattern here, above 30 on the positive, well below 20 on the negative. The ADX is rising. That's a good sign. Looking at the RSI and the CCI, you can see we are above 60. In fact, the weekly CCI got well above 100 this week. It was almost there last week at 91. It got all the way up to over 200 this go around. And then you can see kind of the breakout pattern there, but that's on the daily chart, of course, getting the breakout patterns too, above 60, above 150. That's a good sign. Looking at the Ichimoku cloud, you can see the trend is actually just starting. All right, we're above the cloud. We're not even above 1 or above 50 yet. So if we are to get a new bullish trend here, it's just barely getting going. And then finally, looking from the Bollinger Bands and the Keltner channels, you can see we are in the upper quartile of the bandwidth, almost at the top of the bandwidth there, at the 95th percentile. Good strong momentum today as we've gone from negative momentum to positive. We closed above the Keltner channel. The bands are outside the Keltner channels. So very good kind of breakout type move. So what we decided to do here, again, considering the type of move that we've had in the broader market, is say, okay, let's sell the 145 here and buy the 140. You can see it gets us right about, if we can get $1.16, that's a 30% return on risk. That's the ideal scenario there. If you take a look at that, that puts our break even. There's that trade right there. It puts the break even just barely underneath that gap. So this kind of runaway gap that we got here last week, as long as we can hold that kind of post-earnings gap, then, or actually pre-earnings gap there, but if we can hold this and not fall back into it, then that's kind of the idea. Obviously, if you fall back into it, then I'm willing to lose, $336 out of that $1,000 plus that we're willing to risk. But if it keeps going up and stays up, it doesn't even have to go up, it just has to stay up here, then that's how we make our money on this trade, just essentially through time decay. If we get a little bit of movement higher, if we can get half of this 330 before we get to 20 days expiration, like in the next 12 days, then we can roll it and try to get at the halfway mark and roll it back to a new 30% return on risk and essentially get 1.5 times the maximum gain for the same level of risk. So that would be kind of our ideal scenario there. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.